Intel. In August of 2024, the company that invented the modern microprocessor had its worst day on Wall Street in 50 years. Intel missed its earnings targets, suspended its dividend for the first time in the company's history, and announced it was laying off 15,000 people. The stock dropped 26% in a single trading session. That hadn't happened since 1974, just 3 years after Intel went public. To put that in perspective, a new laptop costs maybe $1,000. A decent house in the suburbs, $400,000. Intel lost $25 billion in market cap that afternoon. That's more than the entire GDP of Iceland. All of it, gone between the opening bell and the closing bell. The company that made the chip inside nearly every computer on Earth couldn't give its stock away. Meanwhile, Nvidia was worth more than most countries. The stock ended the year down 60%. The dividend never came back. Silicon Valley Bank, March 2023. SVB, the 16th largest bank in America, announces it needs to raise capital after selling bonds at a loss. That's not great news, but it's not unusual. Banks sell bonds at a loss all the time. What was unusual is what happened next. Venture capitalists started panic texting each other. Group chats lit up across San Francisco. Partners at major VC firms told every portfolio company to pull their deposits immediately. Within 24 hours, customers tried to withdraw $42 billion. The stock dropped 60% in one session. By Friday morning, the FDIC seized the bank. $42 billion in withdrawal requests in a single day. That works out to roughly $170 million per minute. For context, the average American earns about $60,000 a year. SVB's customers were pulling that amount out every 0.03 of a second. The bank that funded the entire startup ecosystem died because of a startup speed bank run. Customers moved faster than regulators could respond. The whole thing took 44 hours. It was the largest US bank failure since Washington Mutual in 2008. Wirecard. In June of 2020, German payments giant Wirecard admitted something unusual about its balance sheet. 1.9 billion euros on the books simply didn't exist. The money wasn't missing, it was never there. Auditor EY refused to sign off on the financials. CEO Markus Braun was arrested. The stock dropped 98% in a week. The company filed for insolvency. 2 years earlier, Wirecard had replaced Commerzbank in Germany's blue-chip DAX 30 index. It was supposed to be the country's answer to Silicon Valley fintech. Instead, it turned out to be the largest fraud in German corporate history. 1.9 billion euros is roughly what it costs to build 3 international airports. Wirecard claimed to have it, then admitted it was imaginary. Braun's COO, Jan Marsalek, fled to Russia and hasn't been seen since. Credit Suisse. 167 years of banking sold for 3% of its peak value. In March of 2023, Credit Suisse's largest shareholder, Saudi National Bank, went on television and said it wouldn't invest another franc. That's it. One quote. The stock dropped 24% in its worst day ever. Within days, the Swiss government forced a sale to UBS for 3 billion francs. 3 billion francs. That's 3% of what the bank was worth in 2007. UBS got a 167-year-old institution for less than the cost of a new sports stadium. Credit Suisse survived 2 world wars, the Great Depression, and the 2008 financial crisis. It couldn't survive a single quote from its own investor. $69 billion in customer deposits fled in the final quarter alone. Archegos Capital. In March of 2021, a man named Bill Hwang lost $20 billion in 48 hours. Most people had never heard of him. Hwang ran a family office called Archegos, which had quietly ballooned from 1.5 billion to 35 billion using something called total return swaps. These are derivative contracts that let you bet on stocks without actually owning them. Essentially, invisible leverage. None of the banks lending to him could see what the others were doing. When one position went wrong, Goldman Sachs, Morgan Stanley, Credit Suisse, and Nomura all hit him with margin calls at the same time. Everything collapsed in 2 days. Here's the thing. Huang had already been banned from trading in Hong Kong for insider trading back in 2012. Wall Street banks gave him billions in leverage anyway. 20 billion is roughly what it would cost to buy every professional sports team in the city of Denver. Gone in a weekend. In July of 2024, a jury found Huang guilty on 10 of 11 counts. Credit Suisse's $5.5 billion loss from Archegos helped kill the bank 2 years later. And those are just 5 examples of companies and people who lost everything in a day or less. If you want to see the rest of this list, and trust me, it gets worse, hit subscribe. Thanks. Enron. 2001. America's 7th largest company collapses after years of cooking the books finally catch up. Enron had been hiding billions in debt inside off-balance sheet entities with names like LJM and Raptor. When journalists and short sellers started asking questions, the whole structure caved in. The stock falls from over $90 to less than $1. 20,000 employees lose their jobs. Many of them lose their retirement savings too, because their pensions were locked in Enron stock. The company encouraged employees to buy more shares right up until the end. Enron was named America's most innovative company by Fortune magazine 6 years in a row. The innovation, it turned out, was accounting fraud. 63 billion in assets is roughly the GDP of Croatia. It was the largest bankruptcy in US history at the time. CEO Jeff Skilling got 24 years in prison. Arthur Andersen, Enron's auditor and one of the big 5 accounting firms, dissolved entirely. Terra and Luna. In May of 2022, a cryptocurrency called Luna went from $80 to functionally zero in about 3 days. Not a slow bleed, a complete wipeout. Here's how it happened. Terra's stablecoin, UST, was supposed to always be worth $1. It maintained that peg through an algorithm tied to Luna. When UST lost its peg, holders panic sold. The algorithm responded by minting trillions of new Luna tokens to compensate, which cratered Luna's price, which made UST fall further, which triggered more minting. A death spiral. The supply exploded from 1 billion tokens to 6 trillion in 72 hours. $50 billion in combined market cap vanished. That's roughly the annual revenue of Starbucks. Gone in a long weekend. Founder Do Kwon had called his followers lunatics and publicly mocked anyone who questioned the system's design. Weeks before the crash, he tweeted, "I don't debate the poor." He fled to Montenegro, was arrested carrying a fake passport, and in 2025 was sentenced to 15 years in prison. Meta. On February 3, 2022, Facebook's parent company reported its first ever decline in daily active users. Apple's privacy changes had gutted Meta's ad targeting, which is how the company makes nearly all of its money. The stock dropped 26% in a single session, erasing $232 billion in market cap. At the time, it was the largest single-day loss by any company in US stock market history. $232 billion is more than the entire market cap of Nike, more than McDonald's, more than Goldman Sachs. All of it, gone in one trading session. Mark Zuckerberg had just renamed the company Meta to signal a pivot toward the metaverse. Investors responded by making it the biggest single-day value destruction in history. 8 months later, Meta crashed again, down another 25% after another earnings miss. The Metaverse division was losing $16 billion a year. Apple. In April of 2025, President Trump announced sweeping tariffs on imports from dozens of countries, including 54% on Chinese goods. Apple, which manufactures nearly every product it sells in China, from iPhones to MacBooks to AirPods, dropped 9% in a single day. That's $250 billion. Over the next 3 days, as markets digested the full scope of the tariffs, the total loss swelled to $640 billion. A cup of coffee costs $5. A new iPhone, about $1,000. Apple lost $640 billion over a long weekend. That's more than the entire GDP of Sweden. It was the worst 4-day stretch for Apple's stock since 2000. The company had spent 2 decades building the most efficient supply chain in history. One tariff announcement turned that efficiency into its biggest vulnerability. It was the worst week for tech stocks since the COVID crash of 2020. NVIDIA, January 27, 2025. This is the big one. Over the weekend, a Chinese AI lab called DeepSeek releases an open-source model that rivals ChatGPT. The catch? They built it for under $6 million, using NVIDIA's lower-end chips. Not the flagship hardware, not the $100,000 server racks, the budget option. The entire thesis behind NVIDIA's valuation was that AI required the most expensive hardware money could buy. DeepSeek suggested otherwise. Monday morning, investors panicked. The stock dropped 17%. By the closing bell, $593 billion in market cap was gone. $593 billion. That's more than the entire market cap of JP Morgan Chase, the largest bank in America. More than the GDP of Argentina. It vanished between 9:30 in the morning and 4 in the afternoon. NVIDIA had passed Apple to become the most valuable company on Earth the previous Friday. It held the title for one trading day. It took a $6 million Chinese AI model to erase $600 billion from the most valuable company on the planet in one day.